Today I will teach you one of the smartest order block scalping strategies you've most likely never seen before. This strategy includes two free indicators that can accurately predict where the price of a security will go in the future. Moreover, it recognizes the actions of big financial institutions and banks who manipulate the market and make 95% of retail traders lose their money. So if you don't want to be one of them, I highly urge you to watch this video till the end and learn this amazing strategy. Like, subscribe, and turn on those notifications so you don't miss out. Now, without further ado, let's get into it. Okay, so we're currently looking at the Bitcoin USDT chart, and this is what the setup looks like. Before we proceed to the rules for the strategy, let's first understand what the order block is. So the order block is considered a market behavior that indicates the pileup of orders from banks and big institutions. These big players place special orders for buying, selling, taking profit, and closing the position. They do not randomly place a position to upset the price and trigger their own order at the worst price that may result in lowering their profit. For that purpose, they try to split their position into small, manageable blocks using order blocks. You can think about them as special kinds of supply and demand formed when there is a block order. And by knowing where these institutions place their orders, we can predict with high accuracy where the market might move in the future. There are two types of order blocks, bullish and bearish, and now let's understand how they are formed. When a bullish impulsive wave forms after the break of a ranging market structure or block, it indicates the formation of a bullish order block. On the other hand, a bearish order block is formed when a bearish impulsive wave that forms after the break of a price range or block. The goal of our strategy is basically to wait for the price action to retest these zones and then enter the trade based on the signals of the indicator that you can see on the bottom. I will also show you how to add these indicators to the chart and what settings to use at the end of the video, so make sure you stick around for that. But for now, let me teach you the actual rules for the strategy so that you know exactly when to buy and when to sell. So here are the rules for opening a buy position. First, the price action must pull back into our bullish order block. Second, the bullish order block must retest at least twice before we can place the trade. This way, we are making sure that there is a significant amount of buy orders waiting at this price. Basically, we cannot rely on an order block that has not been retested before. Rule number 3, we need to have a strong long signal issued by the indicator that you can see on the bottom. A strong long signal has a blue, yellow, or green label. So if you have a grey label, for example, that says long, this signal is not strong enough and you must ignore it. Once you have all of these conditions met, you can go ahead and confidently place a buy order. The stop loss will be set slightly below our most recent swing low, and as for the take profit, you're going to be targeting 1.5 times the risk. As we see, the price bounced off this order block again, and we closed this trade in a nice profit. Okay, here is another example for a long trade. We see that the price pulled back into our order block again. This means that another large portion of pending buy orders will get executed. We also have a signal from our lower indicator here to go long. And as we can see, it is also a strong signal. By the way, when opening a buy position, you should pay attention to the bearish order block. For example, if your take profit exceeded the bearish order block, this would be a signal for you to reduce your risk on this particular trade, because there is a high chance that the price will bounce off this bearish order block and hit your stop loss first. So yeah, make sure you pay attention to that as well. Alright, so we see the market respected the bullish order block again, and we had another successful entry. Here are two examples of why you should wait for the order block to get retested at least once before you enter the trade. For example, if you enter the trade at the first pullback, you are at high risk of getting stopped out. By the way, this is actually what the majority of traders do, so instead of rushing, wait for the price to retest the order block again, then the traders who entered that first pullback will get wiped out, and then the big players will push the price where it is supposed to go. Here's another example. We see we had a pullback, and again a lot of traders placed their buy orders somewhere here and their stop losses got collected again. That's why we're using this amazing indicator to avoid entries like this. For short entries, you're going to be doing the exact opposite. First, you're waiting for the price action to pull back into the bearish order block. Second, the bearish order block must be retested at least once before so that we can consider it as significant. Notice the price action bounced off this order block a few times. This tells us that there is a stack of sell orders sitting at this price and not letting the buyers get through. Rule number 3, once you had the pullback, you're going to be waiting for the indicator to issue a signal to go short. The stop loss is going to be set slightly above the most recent swing high, and you're going to be targeting 1.5 times the risk. Okay, here is one more example for a short trade. So we see that the bearish order block was formed and it got retested twice. We had a signal to go short. This basically tells us that all 3 conditions for opening a sell position are met. By the way, I nearly forgot to mention that you can place long trades using the continuation signals. These signals can be quite accurate and they do indicate a continuation of a long trend. But remember, all the previous conditions for this strategy must be met. Okay traders, I hope you have understood the rules. Now let's move on to the backtesting to find out all the numbers behind this. The backtesting is complete and here are the results. The win ratio for this strategy is 83%, which is crazy high. And because our strategy is so accurate, we managed to gain over 370% of profit on our account after 100 trades. It's worth to mention that the fees are in fact included. The profit factor is 4.31 and we had 11 consecutive wins against 3 consecutive losses. So overall, I would say that this strategy is really solid. It shows really promising numbers in the backtesting, so you should definitely consider forward testing it with paper money. Okay, now let me show you how to build this setup. So first come up here to your indicators tab and search for the Boom Hunter Pro, which is this one here by Verifid. By the way, the settings will stay on default. However, if you don't want to get confused, head over to the style section and disable those weak signals. For the second indicator, you want to add order blocks with signals by Sonar Lab. Then click on the indicator settings. You can just double click on it, come across to your input section and change your bearish order blocks from blue to red. Okay traders, that is the strategy complete. If you do have any questions, please ask them down in the comment section below. If you enjoyed, please leave a like, comment, subscribe, and turn on those notifications so you don't miss out. I love you all. Peace.